Hello, and welcome to Session 11 of the Basic Tax course. We're going to begin Session 11 with a review of the Session 10 quiz answer key. The Session 10 quiz is one of the more difficult quizzes in terms of, well, lots of students typically have problems with it and miss lots of questions. And it's simply because the questions that are in this quiz require you to A, know what tax law is, and B, read a question and interpret all of the contents of the question so that you can extrapolate and calculate what the correct answer is. So you'll see that each of the questions in this quiz, or at least many of the questions in this quiz, involve multiple steps, multiple calculations to finally arrive at the correct answer. So we're going to spend a little more time than is usual taking a look at this particular quiz. And we're going to begin with question number 1. Bob is an interstate transportation worker. During the year, he was on the road away from home for a total of 250 days. After applying the special meal rate limitation for transportation workers, what is the total standard meal allowance that Bob can claim? So firstly, we look at the total number of days on the road, 250. And then you have to have a number in your head. You need to know what it is. It's $59 a day if you're a transportation worker. The second number you need to know is that transportation workers are allowed 80% of the meal calculation rather than the usual 50. So you need to know in your head that the rate for transportation workers is $59 a day. You then take 59, multiply that by 250, and you get a number. That number is 14,750. And now you need to apply the 80% limit. And 80% of 14,750 is 11,800, and presto, that makes D the correct answer. Moving on, question number 2. You are an employee of ABC Company, and during the year you drove your car a total of 25,000 miles, of which 20,000 were business miles. You are claiming actual expenses, and your operating costs for the car were as follows. Well, you can see here in the quiz that what I've done is I've highlighted in green the expenses that are deductible, and then I've drawn a line through the expense that is not deductible. But there's also this notation here. You can see this 250 is not highlighted in green, and I have a little comment here. Yes, it's deductible, except we get 100%. So let's think about these items. When you're trying to determine how much of the actual operating costs of a vehicle are deductible, you first need to begin with the business use percent. So that's the starting point for this problem. 20,000 business miles out of 25,000 total miles. That equals 80%. 20 divided by 25 is 80%. We then look at the expenses that are auto expenses that would be prorated based on the business use percentage. And that includes gas, maintenance, new tires, insurance, and depreciation. You add those numbers up, and you get a total of $8,950. You then multiply $8,950 by 80%, and you get $7,160. Now, car loan interest is not deductible on Form 2106. It simply can't be carried to Schedule A, although auto loan interest can be deducted on a Schedule C as a business expense. You can forget it on Schedule A, so we throw that number out. And then with the parking, this is business parking, and you're not going to prorate business parking by the percentage business use because it's 100% business. So we pull that number out and claim it in full. So ultimately, we take the business percentage use against the expenses that are proratable. And then we take the full business use on the parking. So ultimately, it's $7,160 for 80% of the amounts shown in green, plus $250, and that gives us $7,410. And you'll also note here that it says, what is the allowable job expense before the 2% limit is applied? And before the 2% limit is applied, it's $7,410. Moving on to question number 3. You are an employee under a non-accountable plan. Your employer reimbursed you for the following expenses through a meal and allowance plan. Well, firstly, we have to interpret what does non-accountable mean. Non-accountable means that your employer gives you an allowance. You do not report expenses back. Your employer does not reimburse you, nor does your employer ask you to refund the employer any amount of expenses or of money not actually spent on expenses. It's non-accountable. They give you the money, and because it's non-accountable, they have to include it in your income as wage income. So if you had a W-2 and your employer gave you $1,000 a month of spending allowance for business expenses, your W-2 by the end of the year would have an extra $12,000 reflected in Box 1, all of which would be subjected to all of the usual taxes. So that's what non-accountable means. Now, if you use that allowance at will to pay for business expenses, you would track your business expenses normally, and you would claim on 2106 all of the allowable expenses, subject to any limitations you have. So let's read this problem again. You are an employee under a non-accountable plan. Your employer reimbursed you for the following expenses through a meal allowance plan. Car $3,500, education $1,000, meals in full $500. Well, what's your job here? Meals in full $500. And then it says your AGI for the year is $40,000. Based on the expenses shown, what is your allowable deduction for employer expenses after, or for employee expenses after you claim the 2% limit? Redo. Your AGI for the year is $40,000, and based on the expenses shown, what is your allowable deduction for employee business expenses after the 2% income limitation is applied? So firstly, we look at the expenses that are shown. Car, $3,500, education, $1,000. And how do we go about claiming those particular expenses? Well, the actual car expense and the actual education expense does total $4,500 and is allowed in full. We're telling you that is the amount of allowed expense he has. But then the meal, we have to apply that 50% limit. And 50% of $500 is $250. So we take $4,500, add $250, and we get $4,750. Next, we have to take the 2% limit. Well, 2% of $40,000 is $800, and so we will subtract $800 from $40,000. When we do that, so we take $40,000, multiply that by 2%, we get $800, and then we take $4,750, subtract out the 2% limit of $800, and we get $3,950. And $3,950 is the correct answer. Question number 4. Haas receives a weekly allowance from his employer under a non-accountable plan as a reimbursement for his business expenses. Haas's expenses are greater than his allowance, and which of the following is true? Firstly, A, Haas does not deduct his expenses and his employer does not include his allowance on his W-2. Well, that's totally and completely false because Haas's employer is required to report the money on his W-2 because it is a non-accountable plan. Since no accounting is going on, any money that employer provides to the employee, regardless of how it is spent, must be included in that employee's wage. Next, Haas claims a full deduction for his expenses on 2106, and his employer includes his allowance on his W-2 as wage income. Well, that's it. B is the correct answer. Haas will deduct all of his expenses that are allowable on Form 2106, and his employer will include all of the monies paid for expenses or as reimbursements for expenses in income on his W-2. C, Haas files Form 2106 to claim his expenses, and he reports reimbursements he receives from his employer on 2106. That would be a definite no. And the reason he doesn't report the reimbursements on Form 2106 is because they've already been included in his income on line 1 of his W-2. If he includes the reimbursements on Form 2106, he's essentially including the income twice, and that wouldn't seem right, would it? And then finally, D, none of the above. Well, that's just false because, of course, B is the correct answer. On to number 5. In October, you flew to Sacramento on business. You stayed 4 days for business and then decided to nip up to Lake Tahoe for 3 days before flying home. You had the following expenses: airfare $600, hotels in Sacramento $700, and meal per diem in Sacramento $61 per day. There's also the cost of hotel in Tahoe and a meal per diem for Tahoe. And you can see I've got some comments that are screaming at you here. Finally, with the question, what is your deductible travel expense before applying the 2% limit? Well, the deductible expense is going to be the expense that is ordinary and necessary and has a business purpose. And, of course, the trip up to Lake Tahoe has no business purpose. It's personal pleasure. So the hotels related to the Tahoe trip and the meal expense for the Tahoe trip simply not allowed. We got big no next to that. But then we have the airfare. Is that allowed? Yes, it is. The hotel in Sacramento, $700. Is that allowed? Yes, it is. And then the meal per diem for Sacramento. Yes, that is allowed. So we have 4 days on business. We're going to take $61 per day, multiply that by 4 days, and we get $244. But, of course, we have to apply the 50% limit, and when we do that, we get $122. So we'll take $122 plus $600 plus $700, and when we add those up, we get $1,422, and that makes C the correct answer. Number 6, you are operating a not-for-profit carpool. You receive payments from your passengers who share a ride to work with you each day. Which of the following is true? A, you should include the income as other income on line 21 of your Form 1040 and then claim your expenses as a miscellaneous deduction on Schedule A. No, you don't need to do that. B, you do not include the payments you receive in income, and you do not claim your car expenses as a deduction. That is the true statement. And C, you should claim actual expenses because you're running your car for hire. Well, no, not for profit tells you it's not for profit and definitely not for hire. All right, moving on to question number 8. Rick took a client to dinner after an all-day business meeting. He hired a cab to take them from the office to the restaurant and back again. The cab fare totaled $15. The cost of the meal was $125. Rick left a $25 tip. Rick was not reimbursed for the cost of these expenses. What is his allowable deduction before the 2% limit is applied? Well, this question often gets people. A little bit confused they are by the concept of, what about that cab fare? Is it considered to be a part of the entertainment expense, or is it a transportation expense? Well, in fact, it is a transportation expense, and as such, it is not subject to the 50% limit. But the meal and the tip on that meal are subject to the 50% limit. So you'll take $125 and add 25. That gives you $150. You multiply $150 by 50%, and you get $75. Next, we take the $15 cost of the cab fare, and when we add that in, we get $90. That makes C the correct answer. Number 9, which of the following is a deductible educational expense? As we go into looking at the responses or the possible choices for this question, let's think about what the rule is about claiming a deduction for education expenses on Schedule A. The deduction, or the expense rather, must directly relate to your current line of work, and it must improve your job skills or be required by your employer. But it cannot be required by your employer as a condition of employment at all. So it can't allow you to meet the minimum requirements for a job, and it can't qualify you for a new profession. But remember that there are some special rules that say a teacher who obtains an educational credential to move from a teaching position to an administrative position, or from an elementary school to a senior high school, those types of job shifts are not considered to be new professions because it's all still in the teaching realm. Teachers do get a little bit of special treatment here, but no one else does. So let's read number 9. Which of the following is a deductible educational expense? A, an attorney studies for his CPA credentials because he wants to practice business law. Well, the attorney is already an attorney, but he is not already a CPA. And the fact that the CPA credential will make him a good business attorney is not as relevant as the fact that the CPA credential itself will qualify him for a new profession as an accountant. And therefore, A is thrown out. B, a teacher studies for her PhD so she could become a school administrator. I already kind of gave this one away, that when you move from a teaching position within an educational system to an administrative position within an educational system, that is not considered to be a new career, and therefore educational expenses involved in that are still allowed. C, a law school graduate pays $400 for the Oregon bar exam. Clearly, a bar exam is required for admittance to become a lawyer, and therefore is not allowed. D, a police officer from Kansas must obtain a bachelor's degree before he can work for the Portland Police Department. Well, this is a problem. He is a police officer in another state, but he wants to move to a new state, and the new state requires he has a bachelor's degree, which he doesn't have. So getting a bachelor's degree would mean he is meeting the minimum requirement for a job or for the new employer, and as such, because it is meeting that minimum requirement, it would not be allowed. Question number 10. Ben often takes his clients to sporting events and dinner. He is very careful to ensure that these entertainment activities immediately follow a substantial business discussion. His only business expenses were for entertainment and meals. His meal expenses for the year totaled $3,200, and his cost for tickets at sporting events totaled $2,000. Ben's AGI is $45,000. What is his allowable business deduction after applying the 2% limit? All kinds of numbers being thrown out at you here, so the first thing I do in preparing to talk about this problem is I underline the numbers. And also this statement right here. What are his allowable expense deduction after applying the 2% limit? So, of course, we need to apply the 2% limit. We can see that $45,000 is his AGI. 2% of $45,000 is $900. So we've calculated that number and just shoved it over for when we need it. His meal expense for the year totaled $3,200. We know that that will need to be applied or be multiplied by the 50% limit. And then we also have the cost for tickets to sporting events. Well, sporting events are a form of entertainment expense. So he has meals of $3,200. He has entertainment expense of $2,000. We add those two numbers together. 32 plus 2 equals $5,200. Both those amounts are subject to the 50% limit. 50% of 5,200 is 2,600. We then have to subtract out that 2% of AGI limit. 26 minus 9 is $1,700, and that makes B the correct answer. Number 11, which of the following is not a deductible expense? Travel to seek your first job, business travel to Europe, entertainment of clients in your tax home, or dry cleaning while on a business trip. Happens to be anything associated with obtaining your first job is never allowed as a business deduction by an employee. It's off the table. So travel to seek the first job is the correct answer because the question is a negative type of answer. Which of the following is not deductible? A is not deductible, but all of the other three options are deductible. And last in line, we have the mini problem. And again, this is a fairly complex mini problem. We're asking you to fill out a two-page form, Form 2106. And I'll just pull the 2106 up here on the screen next to us. And we can see here it says Adam Cartwright incurred the following work-related expenses during the year. He had 12,000 business miles, 2,000 commute miles, 5,000 other miles. He also had meal and entertainment expenses of 1,000, office supplies of 500, travel of 1,200. His occupation is a salesman. He is a degree candidate in a marketing program. His educational expenses for the year were another 6,000, and his employer reimbursed 50% of his meal expense. So lots of numbers that I've thrown at you here. You kind of just need to take each one in turn. Let's just start with the mileage, top of the list. And we've got some important figures going on here. And all of the information that I've shown you in the problem is required on 2106. But we start 2106 with the mileage information essentially by filling out Part 2 on page 2. And so you can see we did make up a date placed in service for the vehicle on line 11 here. But what we're really interested in is lines 12 through 17 and how we get those numbers. Where do they come from? Well, firstly, on the mileage, I tell you that there's 12,000 business miles, and so we'll enter that on line 13. I tell you that there's 2,000 commute miles in the problem, and there you can see line 16 asks for the commute miles. And then I tell you that there's 5,000 other miles, so we enter that on the other miles, line 17. And where does line 12 come from? Well, you simply add up. 2 plus 5 plus 12 equals 19,000 miles. How do we arrive at a business use percentage of 63%? Well, you need to add up all of the miles total, which is 19,000, and divide that into the business miles. So 12,000 business miles divided by 19,000 total miles is 63.16%, so that carries over to line 14. And then we look at the mileage expense itself, and the standard mileage rate for 2012 was 55.5 cents per mile. We've got 12,000 business miles multiplied by 0.555 equals $6,600. That formula is also shown directly on the line 22 of the 2106 for you. You didn't even need to know the number because we threw it at you in the form. We gave you that information. And then, by the way, that's something to look for if you're involved in a mini problem, such as those provided by the Oregon Tax Board at the LTC or the LTP exams. Very often those forms might have some give me answers on them for other questions appearing elsewhere in the test. So one of the strategies I suggest is that when you first open up an exam, if they've given you any forms in that exam, just kind of look for them. See if they've given you any forms, because then if you're familiar with the forms that are in the exam, as you're taking all of the other multiple choice questions and true-false questions throughout the exam and you come to one that relates to a form that they've given you, you can kind of do a cheater and take a peek at it. All right, so $6,600 is the total mileage expense, and that carries up and gets entered on line 1 of Form 2106. Next in line, it asks for parking fees, tolls, and transportation. And what did we give you? Well, we gave you nothing that fits on line 2. And then travel expense while away from home overnight, including lodging, airplane, car rental, etc. And we told you that travel was $1,200, so we enter $1,200 on line 3. Then it says all of the other business expenses that you had. Well, what other expenses did we give you that we haven't already used somewhere else? Well, there is the office supplies, and then there is the cost of the educational expense. So $500 plus $6,000 is $6,500, and we'll enter that on line 4. We total up all of the amounts in column A, and we get $14,360. And next we go over to column B, and we can see that the meal and entertainment expense is $1,000, and we're going to enter that on line 5. And then in the wording of the problem, we tell you that Adam's employer reimbursed him 50% of his meal expense, so that reimbursement would be 50% of $1,000 or $500, and that reduces his business meal deduction or his business meal expense from $1,000 down to $500. Next, when we get to line 8, you need to, of course, do some figuring here, which is to multiply his allowable meal expense of $500 by the 50% limit. When you do that, you get $250. On line 9, you add line 9B and the line 9A, and when you do that, you get $14,610. And of course, all of the multiple choice questions that follow are just asking you what numbers you calculated and entered on the lines, and if you have seen this form, you know where those numbers came from. So that concludes the review of the Session 10 quiz. Let's now begin with the Session 11 lecture. Good morning, everyone, and welcome to Pacific Northwest Tax School's presentation of Itemized Deductions Part 2. Time to start this class. We have a packed class full of information. And today we're going to be covering non-business casualty losses, unreimbursed employee business expenses, and other miscellaneous itemized deductions. There's a lot of information in these topics, and the references that I've provided for you as reading assignments come from several publications, all of which are fairly lengthy. Let's move on to Itemized Deductions and Introduction. And those of you who were here for Part 1 of Itemized Deductions, this is a repeat, but for those of you who did not attend Part 1, that's why we're repeating it again. It's basically an introduction to the concept of Schedule A, its purpose, and its differences from other forms of claiming deductions. You use Schedule A to figure your itemized deductions, and in most cases, your federal income tax will be less if you take the larger of your itemized deductions or your standard deduction. If you itemize, you can deduct a part of your medical and dental expenses, and as well, you can also deduct unreimbursed employee business expenses and amounts that you paid for certain taxes, interest, contributions, and miscellaneous expenses. You can also deduct certain casualty and theft losses. So who must itemize deductions? Well, there's two categories of people who have to itemize. The first group, the group we would run across more commonly, is you have a married filing separate couple. And the rule is that if one spouse itemizes, the other spouse must also itemize. You cannot have a situation where one spouse itemizes and the other claims a standard deduction. That is not allowed. The other situation is rather unique because it applies only to residents of India and only to non-residents of the United States. So if you are preparing a tax return for a person who is filing 1040 NR because they are not a resident of the United States, then they are not allowed to claim a standard deduction. They are required to itemize. And the only exception to that rule is if the person is a resident of India, then they can claim a standard deduction. But residents of all other countries who file 1040 NR must itemize. And for that reason, Schedule A is actually built right into the Form 1040 NR. With the individual 1040 return for residents of the United States, Schedule A is a separate schedule that you have to attach. But for 1040 NR, it is built in. So who should itemize deductions? Well, you should itemize your deductions if the total itemized deductions are more than your standard deduction. Also, if you pay alternative minimum tax, you should itemize. And we're going to briefly touch on alternative minimum tax at the end of the day. But the main reason why you should itemize if you pay alternative minimum tax is that alternative minimum tax rules do not allow you to claim the standard deduction. That deduction is thrown out. So what are itemized deductions? Well, itemized deductions are deductions that you claim instead of the standard deduction. And you can either itemize or claim the standard deduction, but not both. Itemized deductions are reported on Schedule A of Form 1040, and you must use the long Form 1040 if you wish to itemize because you cannot itemize on the short forms. If your itemized deductions are greater than your standard deduction, it is usually more beneficial for you to itemize. An important item to remember about all itemized deductions is that there is no double deducting. If you are able to claim an itemized deduction for an item, and for that same item you can also claim a deduction in another area or a credit in another area, the IRS says you need to choose between them and you can't do both. Here is a picture of 1040 Schedule A. And in Part 1 of our course on itemized deductions, we covered all of the sections of Schedule A that you see here: medical and dental, taxes, interest, and gifts to charity. In today's class, we're covering what seems to be a smaller section of the form, but actually there's probably a lot more to say about this bottom section. Casualty and theft losses is where we're going to start today. Then we'll move on to as well as certain other miscellaneous deductions. And then down at the bottom, you'll see another category of other miscellaneous deductions. The main difference between this bold line running across the Schedule A and the items on lines 21 and 27 and how they differ from line 28 is that when you claim a deduction on line 28, it is not subject to a 2% limit on your AGI. But if you claim a deduction on this section, then it is limited by 2% of your adjusted gross income. So let's move on with the first topic of the day, which is non-business casualty and theft losses, which are claimed on Schedule A, line 20. You may be able to claim a deduction for losses that you sustain due to the loss in value of property due to a casualty or theft. You may not deduct casualty and theft losses that are covered by insurance unless you file a timely claim for reimbursement from the insurance company, and then you must reduce the loss by any amount of reimbursement that insurance company gives you. A casualty loss can result from the damage, destruction, or loss of your property from any sudden, unexpected, or unusual event such as a flood, hurricane, tornado, fire, earthquake, or even a volcanic eruption. We live in the Pacific Northwest here, Portland, Oregon, so it's been a long time since Mount St. Helens blew its top, and we're not expecting anything else in the near future. So volcanic eruptions aren't terribly common here in the United States, although, of course, people who live on the big island of Hawaii might have to be dealing with it occasionally. So a casualty is typically something that's swift, sudden, and unexpected, a natural disaster type thing, but it could also be a fire. And things that are not natural disasters, things that just happen to happen that are really bad luck for you as an individual. But a casualty does not include normal wear and tear or progressive deterioration. One of the things I've noticed about the rules for casualty loss is that how the IRS considers an item and whether or not it treats it as a casualty loss or not is really kind of in sync with how insurance companies look at things. If you have an event that happens to your house and there's significant damage to your house because of the event, let's just say a hurricane, odds are that you're going to have insurance coverage for that. And it's a catastrophic event, and therefore the IRS recognizes it as well. But if by contrast you have a house that is eaten away by carpenter ants over a period of years or by termites, depending on where in the country you are, you have one or the other, then that is a progressive thing. It's not something that happens suddenly. Insurance doesn't cover carpenter ant damage. Believe me, I've been there. And neither does the IRS. It's not allowed as a casualty loss either. So they're not looking or allowing for normal wear and tear, but only for sudden events. So let's take a look at what is a casualty loss. You may be able to claim a deduction for a casualty loss, and to be deductible, the IRS says that the event must be sudden. That is an event that is swift and not gradual or progressive. It must be unexpected, an event that would not normally be anticipated and is unintended. And unusual, an event that is not day-to-day in occurrence and is not typical of the type of activity in which you are engaged. Now, what I have in front of you is a list of all of the things that are shown in IRS publications as having been allowed as casualty losses, and at the same time, in the next column, the right-hand column, a list of things that the IRS has said are not casualty losses. And by reading through these with you, should start to really cement when the IRS will consider there's a casualty loss and when there's not. So examples of allowed casualty losses, that is deductions or losses that the IRS has allowed on tax returns, include things like car accidents, earthquakes, fires, floods, government-ordered condemnations resulting from natural disasters, hurricanes, mine cave-ins, shipwrecks, sonic booms, storms, tornadoes, vandalism, volcanic eruptions, damage caused by insect infestations capable of destroying a tree in 5 to 10 days, death of a horse who swallowed a hat lining, cracking of house foundation walls caused by soil shrinkage during drought, collapse of garage wall from subsoil hydraulic action, damage caused by mine cave-in even though the landslide was reasonably foreseeable, bursting of hot water boiler in home, damage to furniture dropped by movers, damage caused by a flood due to faulty construction. However, the destruction is limited to the cost of the items damaged and not for the cost of reconstruction. Any damage caused by lightning, damage to ring inadvertently dropped in a kitchen garbage disposal, damage to ring caused by a car door slamming on it, damage caused to septic tank by plowing, Damage to a beach during abnormal rains. I think we saw that out with Hurricane Sandy, right? Damage to a home by ice and snow. Damage to a home caused by a hurricane 2 years earlier, but the damage is deductible on an amended return for the year in which that storm occurred. Damage from floodwaters caused by storms. Damage to trees and shrubs caused by accidental poisoning. I was actually at a vineyard a few years ago where they told me that their employee had accidentally put herbicide on the vineyard instead of pesticide, and so their wine crop that year was a little poor. So apparently they didn't kill them outright. They have come back. Okay, damage from floodwaters caused by storms, damage to trees and shrubs caused by accidental chemical poisoning, damage to trees caused by storms and blizzards, loss of trees, grass, and shrubs from fire, damage to household items caused by vandals who broke into a home, and damage and destruction of art objects by vandals. So let's compare that list of everything that is allowed by the types of things that the IRS has definitely said no to. Firstly, we have accidental breakage of household articles such as glassware and china under normal conditions. Damage caused by a family pet. Don't they do a lot of that? Damage caused by a fire you willfully set or paid someone else to set. A car accident caused by your willful negligence or neglect. Progressive deterioration such as the steady weakening of a building due to normal wear and tear. Damage to a water heater that burst after it deteriorated over time. So the water heater itself when it exploded was not allowed. But the damage caused by the exploding water heater to other property was allowed. Most non-business losses caused by drought. Water well that ran dry because of drought. Damage to shrubs eaten by a horse. Damage to antique days by a cat. Damage to fur coat caused by moths. Loss of a valuable dog that strayed off. Damage caused by normal wear and tear of a car. Damage to car caused by overloading the vehicle. Damage caused to car by exposure to salt water. Amounts you pay someone else to compensate for your negligence. For example, a woman paid the owner of a house for damages she caused when she accidentally drove her car into it. The forced sale of a car due to divorce. Damage to a car caused by potholes in the road. Sale of items by a storage company because you did not make payment. And in this case, the event was not unexpected or unusual. The loss of a ring from an owner's finger. The loss of a ring you accidentally threw out. The accidental dropping of your eyeglasses or a watch. The loss of baggage and contents in transit. The snapping of a propeller on a yacht that was not the result of a shipwreck or other casualty. Damage to trees from Dutch elm disease. The disease is progressive and not sudden or unexpected. The gradual suffocation of a tree's root system over a 16-month period. Damage to palm trees caused by lethal yellowing, termite or moth damage, the death of a horse from colic, and loss of livestock due to disease. On the issue of horses from colic, I can tell you that that is actually the #1 killer of horses, so it's not unusual at all for a horse to die from colic. But it is very sudden. When it happens, and either the horse recovers or the horse doesn't make it. Theft losses. A theft is the taking and removing of money or property with the intent to deprive the owner of it. The theft must be illegal under the laws of the state where it occurred, and it must have been done with criminal intent. Theft includes the following acts: blackmail, burglary, embezzlement, extortion, kidnapping for ransom, larceny, robbery, and threats. But theft does not include lost or mislaid property. However, an accidental loss or disappearance can qualify as a casualty if it results from an identifiable event that is sudden, unexpected, or unusual. So, for example, everything in your house is swept away by a tornado. You could say it's lost, and that would be unexpected and unusual. Well, depending on where in the country you are, it may be less or more unexpected or less or more unusual. Loss on deposits. A loss on deposits occurs when a bank or financial institution becomes insolvent or bankrupt. If you incur this kind of loss, you can deduct your loss in any one of the following 3 ways: as a casualty loss, as an ordinary loss, or as a non-business bad debt. How do you report the losses on your deposits? Well, for casualty losses, You figure the loss on Form 4684, and then when you have figured the loss after calculating all of the limits that apply to it, you enter the deduction on Schedule A, line 20. If you decide to claim the loss as an ordinary loss, then you would claim the loss on Schedule A, line 23, subject to the 2% limit. And if it's a non-business bad debt that you decide to treat it as a non-business bad debt, you would report it on Schedule D of Form 1040. And on Schedule D of Form 1040, it would be treated as a short-term capital loss, and it would carry forward because you're only allowed to deduct $3,000 a year unless you have other capital income to offset it. But clearly, since there are 3 different ways to claim that loss, casualty would be the most restrictive, ordinary loss is probably a good medium, and non-business you'd eventually be allowed to recover the full loss. It's just that it's spread out over time. Proof of loss. You must be able to prove that the theft or the loss occurred. The records you are required to keep differ according to whether the loss is from a casualty or theft. If you suffer a casualty loss, your records should show all of the following: the type of casualty and when it occurred, that the loss was a direct result of the casualty, that you were the owner of the property or that you were contractually liable for the property, and whether a claim for reimbursement exists for which you expect any recovery. A theft loss, if you have a theft loss, your record should show all of the following: when you discovered that your property was missing, that your property was stolen, and that you were the owner of the property. Okay, today's class is about non-business casualty and theft losses. And so the next topic is where to deduct your casualty or theft losses. You deduct a non-business casualty loss by completing 4684 Section A. 4684 is actually a 2-page form. Section A is page 1, and that's where you claim non-business casualty losses that are ultimately subject to fairly restrictive limitations, the most significant of which is 10% of your income. Page 2, or side 2, is called Section B, and Section B is used to claim business casualty losses. And on Section B, the 10% limit does not apply. But it's a more complex form and not something we're throwing into Schedule A. We'll show you the form, but we're not really going to discuss it today. Today we are, however, going to discuss Section A of Form 4684. You can see right here it says Section A. And I've color highlighted all of the various sections, and then you can just see the corresponding color of box for a definition or a description of what that box is for. So in line 1, you need to provide a description of each item that is lost. And the IRS wants a separate description for each and every item that you lost. So if you had a storm come through and take away a bunch of your property, damage a bunch of your property, that could be a very long list. They provide space for 4 items on here, and then you would have to attach a statement if it went longer than that. On line 2, you need to enter your cost or other basis that you have in the property. On line 3, you need to enter any insurance reimbursement that you received. On line 4 is where you enter if you have a gain from your insurance premium. So it could be that you had a casualty or theft, you have a certain amount of basis in that item, and then insurance gave you more than that basis. So in effect, that could create a gain for you. On line 5, it asks for the fair market value of the property before the casualty or theft. So up here on line 2, it's saying, what is your cost or other basis? And then on line 5, it's saying, what is the fair market value of your property on the date of the casualty or theft? Then on line 6, it says, what is the fair market value of the property after the casualty or theft? So we're looking at a difference here. On line 5, they want to know what was the property worth immediately before the loss. And on line 6, what is it worth after the loss? And there's going to be a calculation that goes on there to figure that difference, which is what is entered on line 8. Line 8, you're going to be entering the difference or the lesser of your cost basis or the difference in fair market value. And then on line 9, you subtract your insurance reimbursement from the lesser of your cost or the difference in fair market value. Then on lines 10 through 12, you add up the total of all of your losses for this event and carry them over to line 10. You then apply a limit here, which is $100. You're going to enter $100 on line 11 for the event. Then on line 13, you enter the total gain from any insurance reimbursements that you had. And on line 15, if the gain from insurance reimbursements is more than your loss, enter the net gain from all losses on this line and carry the profit to Schedule D. So there's no way to come out ahead in these casualty loss things, it looks like. And then on line 16, reduce the total of all losses by the total of all gains. On line 17, you need to enter 10% of your adjusted gross income. And after taking all of those restrictions out, if you still have a loss for casualty loss purposes, you're going to enter that loss on line 18, and then you carry that loss to line 20. So I have an illustration coming up of that form all filled out in its entirety for a particular loss, so you can see how all those numbers are coming together. Figuring your allowable loss. To figure your allowable loss, you need to determine your adjusted basis in the property before the casualty or theft occurred. You also need to determine the decrease in fair market value of the property as a result of the casualty or theft. And then from the smaller of your basis, or the decrease in fair market value of your property, subtract the insurance reimbursement that you received. So what is fair market value? Well, fair market value is the price at which the property would be sold between a willing buyer and a willing seller, each having knowledge of the relevant facts. Decrease in fair market value. Well, the difference between the fair market value immediately before the casualty or theft and the fair market value immediately after the casualty or theft represents the decrease in fair market value because of the casualty or theft. The fair market value of property after a theft is 0 if the property is not recovered. The fair market value is generally determined by a competent appraisal. Now, if you didn't get a competent appraisal, you could look to replacement cost or the cost of repairs, but that doesn't necessarily truly reflect the fair market value. However, IRS says you may be able to use the cost of repairs to the damaged property as evidence of a loss in value if the repairs are actually made, the repairs are necessary to restore the property to the condition it was in immediately before the casualty, the amount spent for repairs is not excessive, the repairs only correct the damage caused by the casualty, and the value of the property after the repairs is not, as a result of the repairs, more than the value of the property immediately before the casualty. Leased property. If you are liable for casualty damage to property you lease, your loss is the amount you must pay to repair the property minus any insurance or other reimbursement you receive or expect to receive. There needs to be a separate computation for each item of property. So although it might be convenient to look around the house and say, well, I think the value of everything in it was $50,000, the IRS says that's not good enough. You're going to need to list each and everything you have. And actually, the IRS, in some of its publications and on its website when it's putting up advice to people, particularly right now where we've got a lot of tornadoes going on in Oklahoma, a lot of storm damage in the Midwest and out east in general, the IRS has been making a point of telling people, hey, you need to have disaster records in place. You should be going around and making a list of everything in your house. You should be writing it down. You should be securing it in a place that you can recover it if everything you have is lost. Because if you do lose all of your property, you need to be able to show what property you had, what it was worth, and a list does that. So the IRS does provide information on how to keep or compile a list, and it's included in Publication 584, Casualty, Disaster, and Theft Loss Workbook for Personal Use Property. Loss on real estate. Apply the following rules when figuring a casualty loss to real estate not used in a trade business or for income-producing purposes. You need to measure the decrease in value of the property as a whole. All improvements such as building trees and shrubs are considered together as one item, and in that respect don't have to be listed separately. But you still need to figure separately the loss for all other items that you lost. For example, you figure the loss separately for each piece of furniture in your house. Insurance and other reimbursements, you must reduce the loss by the amount of insurance reimbursement that you received or will receive. There's also a rule here about failure to claim for reimbursement. If your property is covered by insurance, you must timely file a claim for reimbursement for your loss. You may not claim a loss for property on which you are entitled to insurance reimbursement but did not file a claim. For example, an insurance claim is not required in this example. You have a car insurance policy with a $1,000 deductible. Because your insurance did not cover the first $1,000 of an auto collision, the $1,000 would not be deductible, or would be deductible, subject to the 110% rules. So you have a car, it has a $1,000 insurance deductible, the cost of repairs is $1,000, so you just don't even file a claim. The IRS says in that situation you wouldn't have to file a claim because you would get nothing if you did. Insurance payments for living expenses. Your casualty loss is not reduced by insurance payments that you receive to cover living expenses in either of the following situations. So what the IRS is saying right here is that some insurance policies provide for temporary living or increase of living expenses if you're unable to use your property or live in your home as a result of the casualty. And if the amount of insurance money that you get to pay for this increase in living expense is greater than the actual cost of the living expense, the IRS says that that difference is going to create taxable income to you. But however, your casualty loss is not reduced by insurance payments that you receive to cover living expenses in either of the following situations. You lose your main home because of a casualty, or government authorities do not allow you access to your main home because of a casualty or threat of one. Inclusion in your income. If these insurance payments are more than the temporary increase in your living expenses, you must include the excess in your income. Report this amount on Form 1040, line 21. However, if the casualty occurs in a federally declared disaster area, none of the payments from insurance are taxable. A temporary increase in your living expenses is the difference between the actual living expenses you and your family incurred during the period you could not use your home and your normal living expenses for that period. Actual living expenses are the reasonable and necessary expenses incurred because of the loss of your main home. Generally, these expenses include amounts you pay for the following: renting suitable housing, transportation, food, utilities, and miscellaneous services. Normal living expenses consist of these same expenses that you would have incurred but did not because of the casualty or threat of one. And here's an example where a living expense is not paid because of the casualty. Todd was forced to leave his apartment after a flood. His normal rent of $500 per month was not payable for the period of time that he could not live in his apartment. Todd stayed in a hotel for 1 month, and for the 1 month period that he could not live in his apartment. The cost of the hotel was $1,000 for that month. Because he did not have to pay rent for his apartment, his increase in living expense is $500. So in other words, the month's cost of $1,000 instead of the usual $500, and therefore his increase in living expense is $500. Here's another example. In this example, we're looking at living expenses are increased due to the casualty, and in this situation, we have taxable income as a result. Justin's townhome was damaged as a result of fire. He vacated his home for 3 months and moved into a motel while repairs were made to his home. Justin's mortgage payment is $1,000 per month. He continued to be liable for and make payments on his mortgage for the 3 months that he lived in the hotel. The motel rent for the 3 months was $4,000. Now, normally, the cost of food for Justin is $200 a month. His food expenses for the 3 months he lived in the motel, however, were $1,500, clearly because he ate out a lot. Justin received $7,000 from his insurance company to cover his living expenses. Determine the payment to include in his income as follows. So we start with a worksheet, and on that worksheet we enter the amount of insurance claim or reimbursement that he has received for his increase in living expenses. We then look at the actual amount that it cost him to live during that time. And the actual expenses were the $3,000 he normally would have paid on his mortgage, because he still did pay it, as well as the $4,000 he paid for the hotel, as well as $1,500 for the food for those 3 months. His actual living expenses totaled $8,500. Now, had there been no casualty or theft loss, he would have still paid that $3,000 mortgage, and his food expense would have been $600 instead of $1,500. So you can say that his normal living expenses for that same period should have been $3,600, but they increased to $8,500. So what's the difference between 85 and 36? Well, it's 49. So his increased living expenses were $4,900, but his insurance company gave him $7,000. Therefore, $2,100 would be taxable income for him. So when is the year of the inclusion? In other words, when do you report that money in your income? You include the taxable part of the insurance payment in the year you regain use of your main home, or if later the year you receive the taxable part of the insurance payment. Here is an example of when Justin would report the income. Justin's main home was damaged by fire in November of 2012, and he regained the use of his home in February of 2013. The insurance payment he received in 2012 and in 2013 were $2,100 more than the temporary increase in his living expenses for that period. He will include $2,100 in his income for 2013 because that is the year he regained use of his home. Disaster relief, food, medical supplies, and other forms of assistance you receive do not reduce your casualty loss unless they are replacements for lost or destroyed property. Figuring a gain. If the amount of insurance payment or other reimbursement is more than your adjusted basis in the lost property, you have a gain from the casualty or theft. To figure your gain, subtract the insurance payment from other reimbursement from the loss, and then the difference is taxable gain. Report that gain on Schedule D. Employer's Emergency Disaster Fund. If you happen to have an employer who's able to do this, that's a good deal for you. If you receive money from your employer's Emergency Disaster Fund and you must use that money to rehabilitate or replace property on which you are claiming a casualty loss deduction, you must take that money into consideration in computing the casualty loss deduction. Take into consideration only amount that you use to replace your destroyed or damaged property. And here is an example where the amount of loss the taxpayer can claim on Schedule A is reduced because they received employer assistance amounts. Your home was extensively damaged by a tornado. Your loss after reimbursements from your insurance company was $10,000. Your employer set up a disaster relief fund for its employees. Employees receiving money from the fund had to use it to rehabilitate or replace their damaged or destroyed property. You received $4,000 from the fund and spent the entire amount on repairs to your home. In figuring your casualty loss, you must reduce your unreimbursed loss, $10,000, by the $4,000 that you received from the employer's fund. Thus, the casualty loss that you are going to be allowed to claim on 4684 is going to be $6,000. Cash gifts. If you received excludable cash gifts from a disaster victim or as a disaster victim, and there are no limits on how you can use that money, you do not reduce your casualty loss by those excludable cash gifts. So essentially, it's possible that you've got insurance coming in, it's possible you've got an employer kicking in some money, and it's also possible you've just got some goodwill around you with people who are giving you money. And the IRS says if people are giving you money, that money you receive as a gift is not taxable. And it's also not anything you need to include in your income or anything you need to use or apply towards offsetting the amount of loss that you have. And it doesn't really matter how you use that money, whether you use it for repairs or whether you put it in the bank. So here's an example of how a cash gift would not reduce your loss. Your home was damaged by a hurricane. Relatives and neighbors made cash gifts to you that were excludable from your income. The reason they're excludable is that gifts received by a recipient aren't taxable to that recipient. You used part of the cash gift to pay for repairs to your home. There were no limits or restrictions on how you could use the cash gift. It is excludable gift, so the money you received and used to pay for repairs to your home does not reduce your casualty loss on the damaged item. Deduction limits. Once you have figured your loss, in other words, that you have a loss and how much your loss is, now it's time to start filling out the form and figuring the limits. Losses on personal use and employee use property are limited as follows. Firstly, we have a $100 rule. You must reduce each casualty or theft loss that occurred during the year by $100 if it's a personal loss. There's also this 2% rule. The $100 rule applies to the 10% but not to the 2% because the 2% is when you have employee business property. You must reduce the total of all casualty or theft losses of your employee use property by 2% of your AGI. And then we have the 10% rule. You must reduce the total of all casualty or theft losses of your personal use property by 10% of your AGI. So here's an illustration of how the $100 rule and the 10% rule work together. Your boat was stolen. Your boat cost you $20,000. Its fair market value on the date that it was stolen was $15,000. Your insurance then paid you $13,000. Your adjusted gross income for the year is $29,500. Your loss after insurance is going to be the lesser of the difference in fair market value or your cost basis, and also factoring in insurance. Well, the lesser is the fair market value. It's worth less than he paid for it, so we start with $15,000. And then from the $15,000, we subtract out the insurance claim, and we're left with $2,000 of loss. Next, we reduce the loss by $100, and we end up with $1,900. Finally, we look at 10% of AGI. 10% of $29,500 is $2,950, and once we've done that, we arrive at a big fat zero where no loss is allowed at all. Now, here in the Pacific Northwest where I live, Portland, Oregon, there are very, very few casualty losses. I've had one casualty loss client in 20 years. We just don't have a lot that goes on here. We had a flood, a major 500-year flood back in 1996. Other than that, it's pretty peaceful, and Mount St. Helens was so long ago that people remember it and talk about it, but there isn't much going on here. So we're a relatively benign area to live. But lots of other areas of the country, I imagine casualty losses are a pretty regular occurrence. If you live in Tornado Alley, if you're in hurricane zones, or if you're in some of the storm zones that we've had on the East Coast, there's probably a good base of clients out there who are qualifying for casualty losses. And it's just good in the back of your mind to really peg that the rule is 10% of the income. And if they have a significant enough loss, they'll have a deduction. But if they can't hit that 10% of their income, they're not going to be able to claim it. And I do see a couple of questions here. Nancy is asking, if you drop a computer in water, is that covered by a casualty loss? I would say yes. It would be sudden, unusual, and unexpected to drop a computer in water. So I would say that's a yes. And then she also asks, if you lose all of your furniture in a storm, do you have to reduce $100 for each piece of furniture or $100 for the whole claim? It would be $100 for the whole claim if it was a single storm. And I'm going to show you some illustrations of how that all comes together. And here we have another illustration where we have multiple losses from a single event. That's the exact question you've just asked, Nancy. On May 10, 2012, Dorothy's home was damaged in a tornado. A tree carried by the tornado fell on her roof, causing extensive damage to the house and home theater system she had inside. There's probably a whole lot more items than that, but I wanted to keep the problem simple so I didn't have to list them all. The fair market value of her home before the storm was $150,000. The fair market value of her home after the storm was $120,000, and she paid $130,000 for the home. Her home theater system destroyed by the falling tree had a fair market value of $4,000 before the storm and a fair market value of $0 after the storm. She paid $12,000 for the system back in 2009. Dorothy's insurance reimbursed her $9,000, and her AGI for 2012 is $29,500. And the $9,000 of insurance reimbursement is actually for the house damage, not anything else. So here we have the fair market value of the assets that were damaged. We have the house immediately before the event was worth $150,000. We have this home theater system immediately before the event was worth $4,000. And the fair market value of all of the assets combined before the tornado was $154,000. The fair market value of assets after the storm, the house was reduced in value to $120,000, and the theater system was worthless. So the fair market value of all of her assets after the loss is $120,000. Total loss in the fair market value of the assets. We have $154,000 as the total fair market value before the event. We have $120,000 as the fair market value after the event. And the difference between those two numbers is $34,000. That's the starting point for figuring the loss. But we first have to subtract out any insurance reimbursement, and I just told you that was $9,000. Once we pull that out, and we now have a loss of $25,000. Next, we have to apply the $100 per event rule and the 10% of AGI rule. And with that, we end up with a $25,000 loss after insurance. We subtract out $100. We subtract out $29.50, which is 10% of AGI, and we're left with an allowable loss of $21,950. So let's see how all of this translates to Dorothy's Form 4684. We're going to start on line 1 of the form by entering a description of all of the assets that were lost. And as I said, I am limited to only 2 assets to keep it simple. The roof of the home and the address and the home theater system and the address of the home theater system. Then on line 2, we enter the cost or other basis of each piece of property for the owner, Dorothy. And she paid $130,000 for her house, and she paid $12,000 for that home theater system. We then subtract out any insurance reimbursement, and the insurance was for the roof, so it goes on line 3. Then on line 5, we're entering the fair market value immediately before the event for each piece of property. It was $150,000 for the home, and it was only $4,000 for the home theater system. We then look at the fair market value after the event, $120,000 for the house, 0 for the theater system. And then we do a subtraction. 150 minus 120 is 30, and 4,000 minus 0 is 4,000. And then the next step we look at is subtracting any insurance claim. And the 9,000 we have up here in line 3 is coming out. And we're also going with the lesser of the 2 numbers. We go with the lesser of 130,000 or 30,000, or the lesser of 4,000 or 12,000. And in both cases, we end up with the lesser numbers entered on line 7 and 8. And we figure the loss on line 9. 21,000 for the roof, 4,000 for the home theater system. 21 plus 4 gives us our total loss that we enter on line 10, $25,000. And now we have space to apply the $100 rule. We reduce 25,000 by 100, we get 24,900. We then move down to line 17. We enter 10% of Dorothy's AGI, 2,950, and then we end up with 21,950 as the allowable loss that she can carry to Schedule A. And if we bounce up the page here, I did include Dorothy's Schedule A. Dorothy Disaster is her name. And we have the deduction being entered on line 20. Let's compare that event with another similar event. But this time, Dorothy's been even more unlucky. She's got 2 events in the same year. So we're going to assume everything still happened with the tornado ripping the roof off her house and destroying her home theater system. But in that same year, Dorothy's diamond ring was stolen, and it had a cost basis of $1,500, and it also had a fair market value of $1,500. She had no insurance coverage for the ring. So how are we going to figure her loss in this event? Firstly, we start with the same assets we had in the first example, the house and the home theater system, and then we have the ring. And we add those amounts up, and we have $155,500. We then look at the fair market value of the assets immediately following the event, which is $120,000 for the house, 0 on the home theater, 0 on the ring. We have a total fair market value of the assets after the loss. And I did want to point out up here that we're starting with the difference in fair market value of the house. And here on the home theater system, we're starting with the lesser of the difference in fair market value, or the basis. And so in this case, we've ended up with 4 rather than the original 12,000. I don't know if you were wondering about that, but that's what's going on there. Then we move down and we add up the total fair market value of the assets before the event, and we add up the total fair market value of the assets after the loss. And when we do that, we end up with $35,500. From that, we subtract out the insurance reimbursement, and we're left with $26,500. And now we're going to go back to this rule of $100 per event. There were 2 separate events. There was the tornado event, and there was the stolen ring event. So $100 will come off twice. We then subtract out 10% of AGI, and this time Dorothy's loss is $23,350. So moving over, this time, because there's 2 events, Dorothy has to do 2 4684s. The first 4684, the one I showed you earlier, is now showing underneath the second 4684. But you can see we stop at line 12. When we figure the loss after the $100 rule, we don't finish out the rest of that first loss. Instead, we go over to the second loss, and we describe the second loss and figure that loss as $1,500. We then subtract out the $100 rule, and we're left with the loss from the second event. Next, it asks, what is the loss in the fair market value of all of the assets from all of the events? And this time, we're going to take $24,900 from line 12 of her first 4684, and we're going to add that to line 12 from the second 4684. And when we do that, we get $26,300. Then we subtract out 10% of the income, and then we figure the loss. $23,350 in this case would carry to Dorothy's Schedule A. So when do you deduct a loss? Well, it depends on the type of loss. If the loss is on a deposit, it depends on how you treat that loss on the deposit. If you treat it as a casualty, then you claim the loss in the year you reasonably estimate that the loss occurred. If the deposit is treated as a bad debt, then you treat it as a bad debt and claim it on the return for the year that the deposit became totally worthless. If it's an ordinary loss, then you claim that loss in the year you reasonably estimate that that loss occurred. If the loss occurs from a casualty, you claim the loss in the year that the loss occurred. But if the casualty is a loss in a federally declared disaster area, then you can either claim the loss in the year of the disaster or in the year immediately before the disaster. So right now we have Oklahoma, which has been victim several times over to tornadoes, and that is a federal disaster area. The IRS on its website has already published information about extending deadlines and so forth for victims in that area. And because those victims in the area of Oklahoma are in a federally declared disaster area, it means that they can claim the loss on their 2013 return, which is the year that the loss has occurred. And of course, they won't be filing that for several more months until we get to 2014. Or they could go back right now, amend the 2012 return, and claim the loss on that return. And then we also have loss from a theft. You claim a loss from a theft in the year that the theft is discovered. So it could be that something you own is stolen and you can't even pinpoint the date that it was stolen. You don't know. It's just gone. You determine that it has been stolen. You file a police report because of the theft. And it is then that you claim that loss, the year that you discover the loss. So I mentioned federally declared disaster areas. Let's talk about those a little bit more in brief. As with other personal losses, disaster losses are subject to the $100 per loss rule and the 10% of AGI limit, and they are deductible only if you itemize your deductions. But if you live in a federally declared disaster area, you are given some special treatment as described next. You can claim the loss on your tax return for either of the following years, that is the year the disaster occurred or the year immediately preceding the year of the casualty. There are also some postponed deadlines. The IRS may postpone for up to 1 year certain tax deadlines of taxpayers who are affected by a federally declared disaster. The tax deadlines the IRS may postpone include those for filing income tax returns and employment tax returns, as well as paying income and employment taxes, and even making contributions to traditional or Roth IRAs. Also, interest abatement. The IRS will abate interest on taxes you owe for the length of your extension if you meet the following requirements. Number 1, you were located in the area that is declared a disaster by the federal government. And number 2, you were granted an extension to file your taxes and you paid your income taxes. Net operating losses. It is possible that if your casualty is large enough, it can trigger an NOL. And if you have triggered an NOL, then you can carry that NOL back to a prior year to get a refund of taxes that you already paid, or you can carry the loss forward to next year. Damage from corrosive drywall. Under a special procedure, you may be able to claim a casualty loss deduction for amounts you paid to repair damage to your home and household appliances that resulted from corrosive drywall. If you want to read more about that, go to IRS Publication 547. Now, I have a table that I've put up here. It comes out of IRS Publication 547, which is the Casualty and Theft Loss publication. It does a nice job of summarizing the rules that apply to different types of casualties for personal use property. Firstly, we have the general application of the $100 rule. You must reduce each casualty or theft loss by $100 when figuring your deduction. You apply this rule to personal use property after you have figured the amount of your loss. Then there's a 10% rule. You must reduce your casualty or theft loss by 10% of your adjusted gross income. Apply this rule to personal use property after you reduce each loss by the $100 rule. And then we have the 2% rule. You must reduce your total casualty or theft loss by 2% of your adjusted gross income. Apply this rule to property you used in performing services as an employee after you have figured the amount of your loss and added it to your job expenses and most other miscellaneous itemized deductions. So if you have a loss in property you used as an employee, ultimately it becomes an employee business expense deduction rather than a personal loss expense. And therefore it carries to a different line of Schedule A. It would not be entered on line 20. If there is a single event, you apply the $100 rule only once, even if there are many pieces of property affected. The 10% rule, for a single event, you apply this rule only once, even if many pieces of the property are affected. And finally, apply this rule only once if you are an employee, even if many pieces of property are affected, in terms of the 2% rule. Do you see a question from John Michael Ridner? How does the loss trigger an NOL? Well, this is not a class on net operating losses, but a net operating loss is essentially a situation where you look at the front page of your tax return, and I tend to think of an NOL is when you get to line 22 where you total up all of your income, that number on line 22 is negative. But there are certain types of losses or expenses that can be claimed on Schedule A such that even if you have a positive number on line 22 on the front page of your return, that when you get over to Schedule A and you factor in the deductions you have for employee business expenses and for casualty losses on your Schedule A, that if you subtract those from your income on the front page of the 1040, that you could end up with a negative number. And if you have a negative number, you're essentially at an NOL. It's a very simplistic way of describing it. Net operating losses are incredibly complex. I've done a few of them in my lifetime, and they're horrible to compute. The IRS wants you to fill out various worksheets for figuring the NOL. And then you also have to figure out separate worksheets all over again to figure NOL under alternative minimum tax rules. And I've never created a course on how to do it. It's something that I could do in the future, but it's not something I've put a high priority on. But you could have an NOL as a result of a casualty loss if ultimately the loss was so great it offset all of your other income and put you into a negative number situation. Moving on with this table of where and when to do things, in terms of the event, if you have more than one event, such as Dorothy with her tornado and then the second event, which is the stolen ring, we're going to apply the $100 rule to each event, but we're still going to only apply the 10% rule once. And with regards to the 2% rule, we're going to apply that 2% rule to the total of all losses from all events. For more than one person, let's just suppose that 2 or more people own the property that was damaged or stolen. Well, with regards to a loss from the same event, if you are not a married couple filing a joint return, then the loss will be applied separately to each person in terms of their share of the ownership, and the $100 rule will also apply separately to each person. The 10% rule will also apply separately to each person, and if they're claiming it as an employee business expense, the 2% rule will apply separately to each person. If we have a married couple with a loss from the same event and they file jointly, the $100 rule is applied only once, and the 10% rule is applied only once. But if they file separately, the $100 rule is applied to each of them separately, and the 10% rule is applied to each of them separately. And then if there's more than one owner other than a married couple, you apply separately the $100 rule to each owner of the property that is jointly owned. You apply the 10% of AGI rule separately to each person. And then if it is business property, we apply the 2% rule separately to each person based on their separate tax returns. Maritimes, M-A-R-I-T-I-M-E-S, Maritimes. Now, what happens if you have a loss on business or other income-producing property? Well, that's a more complex topic. I don't really have a course on it, although I could. I don't know if I will this year. The place I would put it is under sales or other dispositions of business assets. I have a course coming up in our series called Sale of Assets, and in that course we talk about Schedule D, which is where you report capital gains and losses. But we actually spend the majority of our time talking about sales and other dispositions of business assets, and those are reported on Form 4797. If you had a casualty loss, you would report that casualty loss for your business asset on Form 4684, Section D, but you would also have to report that loss on Form 4797. Section B of Form 4684 and the 4797 essentially talk to each other, and that's a fairly complex calculation, not one I'm going to get in here today, but I thought I would at least explain to you that that calculation goes on and where it goes on. And ultimately, because it is a business loss, the $100 rule does not apply, the 10% rule does not apply, and the 2% rule does not apply. In other words, if it's a business loss or an income-producing loss, it's likely the case you could claim the entire loss. But if it is an employee business expense type loss, or if it is an investment expense type loss and not from an actual business ownership, then the 2% rule does still apply, but the 10% and $100 rules would not apply. So if the business casualty or theft loss involves property used in a passive activity, you also have to look at Form 8582 Passive Activity Loss Limitations and its instructions. And we cover 8582 in our course called Passive Activity Loss Limits and Rental Property. That's also coming up in the next couple of weeks. If you incurred a casualty loss in your trade or business, different limits apply as follows. Firstly, the $100 rule and the 10% rule does not apply. If the loss occurred to employee business property, claim the loss as a miscellaneous itemized deduction subject to the 2% limit. If the loss is associated with business activity reported on Schedule C, Schedule F for farming, Form 1120S for S Corporation, or Form 1065 from a partnership, then if the property was completely destroyed, the loss is generally the cost of the property minus accumulated depreciation. Fair market value that is less than the basis does not reduce the allowable loss. So with a personal loss, let's say your car is lost in a storm and it's your personal use car, you would have to look not at what you paid for that car, because probably it's far more than what it was worth. Instead, you'd be looking at what it was worth, its reduced basis. But that same car, if it was used as a business asset, if it was a business-owned car used for a business, and I'll make it 100% business use just for clarity, if that same car was used in a business, the business would be able to claim a loss based on its adjusted basis. It's probably less than what it paid for, but it might be worth, the adjusted basis could be more than what it was, the fair market value was. So we're not interested in fair market value in terms of computing the loss for a business. Instead, we're always looking at the basis or the adjusted basis. If the property was damaged but not destroyed, the loss is generally the decrease in the property's fair market value up to the adjusted basis, but not more. Loss of inventory. There are two ways you can deduct a casualty or theft loss of inventory, including items that you hold for sale to customers. The first one is to deduct the loss through the increase in the cost of goods sold by properly reporting your opening and closing inventories. Frankly, that's the one that's self-evident for me, because when you are preparing cost of goods sold or figuring cost of goods sold, you start with your opening inventory, you figure all of your purchases and expenses related to inventory for the year, you subtract out your closing inventory, and you have your cost of goods sold. And it seems self-evident that if you have a casualty loss that destroys all of your inventory, that bottom number that you subtract out is going to be much lower than it otherwise would be. And so there's not really a whole lot of effort that goes into figuring the casualty. You're not going to have to do include it on the 4684 at all as far as I'm concerned, because you would just treat it through cost of goods sold. That's the simple way. However, there is a second way that you can do it, and that is to deduct the loss separately. To deduct the loss separately, you must eliminate the affected inventory items from the cost of goods sold. That means you're going to have to account for it in cost of goods sold by reducing the amount you purchased during the year. There's going to have to be a separate calculation going on in cost of goods sold so that you don't double count it clearly. Then you reduce the loss of the reimbursed by any reimbursement that you received. Do not include the reimbursement in your gross income, however. And if you do not receive reimbursement by the end of the year, you may not claim a loss to the extent that you have a reasonable prospect of recovery. So what they're saying is here, you can go up and you can claim it as a reduction in the ending inventory. So you could look at it as an inventory item. You're going to treat it as an extra cost in inventory. But if you do receive insurance reimbursement, you need to include that insurance reimbursement in your gross income. The other is to deduct the loss separately, but you can't claim the loss until you receive an insurance reimbursement, and you have to wait till that insurance reimbursement comes in, and once it does, then you claim the loss. So two possible ways to do it. Again, I think number one is probably simpler, but the IRS does allow for option number two. Cost of repairs. The cost of repairing damaged property or cleaning up after a casualty must be capitalized if the owner takes a casualty loss deduction for the property. And there is a memorandum you can read about that, 2006-006. And moving on with the next line of 1040, line 22 of Schedule A, you'd think that should be the simplest line for a tax preparer to understand, but there is a couple of important things to say about it. You can usually claim a deduction for tax preparation fees on the return for the year in which you pay them. Thus, on your 2012 tax return, you can deduct fees paid in 2012 for the cost of preparing the 2011 tax return. Deductible fees include amounts you pay for a tax practitioner or firm to prepare your return, the cost of tax preparation software programs, tax publications, and any fee you paid for electronic filing of your return. Where to deduct? Expenses you pay to prepare your individual return are claimed on Schedule A, line 22. However, costs attributable to preparation of business tax returns or schedules are claimed on the related forms as follows. Expenses for preparing your tax schedules relating to profit or loss from self-employment, that portion of the tax preparation fee would be claimed on Schedule C. And if you prepared Schedule E for your client, then the portion of the preparation fee allocable to Schedule E would be entered on Schedule E, and the same goes if you are preparing a farming return. You deduct expenses for preparation of any other forms that are not business forms on Schedule A, and you enter those on line 22, which is the highlighted line right here. Now, there are a variety of other miscellaneous deductions that are deductible, subject to the 2% limit, that are not considered to be employee expenses. And we're going to talk about those real briefly here. The first one that jumps to mind are losses on IRAs. And it's very often the case that a client who has an IRA might lose money on it. It's just been my experience with Roth IRAs that there's all these incentives to invest for the future, but with the market crashes that we had in recent years, people were finding that they'd put money into these Roth IRAs and then they were losing money on their Roth IRAs, and then they were cashing the Roths out because they needed the money to live on. And in situations like that, you have a loss. And is the loss deductible? The answer is yes. For traditional IRAs, if you have a loss on a traditional IRA investment, you can claim the loss on your tax return, but only when all amounts in all of your traditional IRA accounts have been distributed to you. In other words, you've closed out all of your traditional IRA accounts, and the total distributions are less than any unrecovered basis you have. Your basis is the total amount of the non-deductible contributions you made to your traditional IRAs. And most people who have traditional IRAs have little or no basis. But with Roth IRAs, most people have a basis because everything in a Roth is creating a basis. If you have a loss on your Roth IRA investment, you can claim the loss in your income tax return, but only when all of the amounts in all of your Roth IRA accounts have been distributed to you and the total distributions are less than your unrecovered basis, if any. Your basis is the total amount of contributions you made to your Roth IRAs. So here are some other deductions that are subject to the 2% limit. They include appraisal fees for donated property or to compute the cost of a casualty loss. So earlier today we talked about figuring your casualty loss and that you need to get an appraisal for that. Well, you're probably going to have to pay money for that appraisal, and the cost of the appraisal is not a part of the casualty loss. You enter that appraisal fee, whatever it is, on line 23 of Schedule A, and you subject it to a further 2% limit above and beyond the 10% you were already subjected to in terms of calculating that loss. And if you donated property to charity and you were required to have a qualified appraisal because the value was $5,000 or more than $5,000, that too is subject to the 2% limit. Casualty or theft loss of business property used by you as an employee, depreciation of home computer to manage investments, excess deductions on an estate, legal expenses paid to produce or collect taxable income, loss on deposits with insolvent or bankrupt financial institution, investment fees and expenses, clerical help and office rent connected with investment income, fees to collect interest and dividends, service charges on dividend reinvestment plans, trustees' administrative fees for an IRA, but only if the fees are paid from funds outside of the IRA and not from within it, a safe deposit box rent used to store taxable income producing documents. There was a question earlier about whether cash in a safe deposit box would qualify, and since cash is not an income producing document, I would say not. Indirect deductions of partnerships and S corporations and non-publicly offered mutual funds. Repayment of Social Security benefits is greater than the benefits received by $3,000 or less, or repayment of income is $3,000 or less. All of those are miscellaneous itemized deductions that are reported on line 23. And finally, hobby expenses to the extent of hobby income, losses on complete distribution from a traditional or Roth IRA, and the convenience fee charged by the credit card processing for paying your income taxes by credit card is also deductible on Schedule A, line 23. The next table shows some other deductions that you might run across with your clients that are not subject to the 2% limit. And these deductions are entered on line 28 of Schedule A. They include amortizable premiums of taxable bonds, casualty and theft losses from income-producing properties such as stocks, vacant land, and works of art, federal estate tax on income in respect of a decedent, gambling losses up to the amount of gambling winnings, but you must keep an accurate diary of your wins and losses to claim those. Impairment-related work expenses for individuals who have physical or mental disabilities. You figure those expenses on Form 2106, and instead of entering the deduction on line 21, you enter it on line 28. Repayments under a claim of right greater than $3,000, including repaid wages. So let's just suppose your employer paid you a $10,000 sign-on bonus with the requirement that you stay with them a minimum of 3 years, and after 2 years you left, so you're required to repay the $10,000. That would be a deduction you could claim on Schedule A, not subject to the 2% limit, as long as the repayment in that year exceeded $3,000. Similarly, if you had to repay Social Security benefits that are more than $3,000 and you repaid more than $3,000 more in the year than you received, that also is not subject to the 2% limit. Unrecovered investment in an annuity on a final return of a decedent, officials employed by a state or local government on a fee basis, and travel expenses of Reserve and National Guard service members who travel more than 100 miles away from home overnight, but those expenses are reported on Form 2106 and then they carry to 1040 line 24. They are not entered on line 28. And the same is true of the fee basis official expenses. Those also are claimed on Form 1040 line 24 and reported on 2106. I have some information in here about gambling losses to the extent of gambling winnings. Some key rules about that is there has to be a diary of the wins and losses, and you have to be able to prove the wins and the losses. Depending on the type of gambling you do, The IRS has different rules about the type of record you need to keep, and I copied all of these out of IRS publications to show you the type of record keeping they expect for gambling, and it's quite specific. The final bit I'm going to give for you today is one last illustration where we're claiming some unreimbursed expenses as well as other miscellaneous deductions on Schedule A and how they all piece together. We have a character named Hugh Grant who has adjusted gross income of $172,000. He has gambling losses to the extent of gambling winnings totaling $2,000. He paid a tax preparation fee of $250. He has deductible education expenses of $7,500 and deductible hobby expenses of $500. Obviously, in sync with that, he would have had to have reported at least $500 of hobby income. Because the education expense involved nothing to do with reimbursements, travel, or meals, or auto, we don't have to attach Form 2106. We simply type the word description education and the amount of the education expense. For hobby expense, we enter that on line 23, and for the tax preparation, we entered that on line 22. We enter his adjusted gross income on line 25. We multiply his AGI by 2%, and we get $34.40. We added up lines 22, 21, and 23, and on line 24, we entered $82.50. We subtract $34.40 from $82.50, and we have $4,810 as his allowable deduction. He also had gambling losses of $2,000. Those are not further limited, and he is allowed that in full. So he would take $4,810 and add that to $2,000 plus any other itemized deductions that he might have. There are also a note in here about Ponzi-type investment schemes. And if you are a victim of a Ponzi scheme, you're actually the victim of a theft in many ways. And so any losses with regards to Ponzi schemes are figured on Section B of 4684 and claimed that way. And finally, we're going to end today's class with everything you're not allowed to deduct. I gave you a long list of everything you can deduct. We spent all day talking about what you can deduct. But just to wrap it up, I thought I'd point out a few things that IRS has gone out of its way to specifically say are not deductible. Beginning with brokerage commissions paid in connection with your IRA or other investment property, burial and funeral costs, capital expenses such as equipment, building, and other assets. It's possible that those costs can be depreciated if you are filing a business return, but if they have anything to do with personal use property, they are not deductible. Fees and licenses, including car, marriage, and pet licenses, hobby losses, home repair, insurance, and rent, except as allowed for under rules for home office expense as unreimbursed employee business expenses, or because perhaps it was a rental home. Illegal bribes and kickbacks are not deductible. Loss on the sale of personal property, such as your home, car, or other personal property not used for business. Personal disability insurance premiums, personal living or family expenses. The value of wages you never received or lost vacation time. Remember, if you did not include the wages in your income, you've never paid tax on them, therefore you have no tax basis on which to claim a deduction. Campaign expenses, even if the candidate is running for re-election. Check writing fees on a personal account. Club dues, including clubs where you meet to discuss business. Commuting expenses. Entertainment facilities such as yacht, ballroom, clubhouse, hunting facility, swimming pool, tennis court, bowling alley, car, airplane, apartment, hotel, suite, or a home in a vacation resort. Well, this is an interesting one because several years ago I did tax return for a real estate agent. And she each year likes to host a party to entertain all of her real estate clients. She's got lots of them. She's been in the industry for a long time, and she just likes to throw this party. And one year she decided to do an extra big party, and she rented a ballroom for it. And back then, this kind of rule about entertainment facilities, it just slipped my mind. She told me the cost of the ballroom, and we put it on a return. And our bad luck, she got audited, and darn, they allowed every part of the party except the ballroom itself, which was a relatively minor cost. The cost of food is much higher. But since that time, I've actually held some training seminars, like the one I'm doing here online, but I've held them in facilities like restaurants that have meeting rooms. And what I've noticed is that once you've paid a certain amount for food, the cost of the meeting room drops dramatically, sometimes even down to zero. And it finally dawned on me, maybe they've just figured out that if they just charge you for the food, you can claim everything and they don't have to worry about the room itself. I don't know if that's a true motive or not. It's just something I observed. Other things you can't deduct are fines or penalties, health spa expenses, even if your job requires excellent physical conditions, such as a law enforcement officer, home security system, except as allowed for under home office expense, homeowners insurance premiums, except as allowed for under home office expense, investment-related seminars, life insurance premiums, and if you pay premiums on policies assigned to your former spouse, they may be treated as alimony. Lobbying expenses, loss or mislaid cash or property. Meals with coworkers, except when you are traveling for business or otherwise qualify to claim entertainment expenses. So this is a real common one as well. Well, you know, every Friday my coworkers go and we have dinner after work on Fridays and we talk business. Well, you're going to have to really show that there's a business motive there and that it's just not really happy hour on a Friday. Because if it's happy hour on a Friday, it's not going to be allowed. Meals while working late. These are non-deductible as well. You stay late at work, so you order in a pizza. Not going to be allowed unless you're qualifying for travel or entertainment expense. Personal legal expenses incurred for such things as child custody, breach of promise, civil or criminal charges, personal injury, preparation of will or divorce. Political contributions. Professional accreditation fees. The initial fee you pay to become accredited as an accountant, lawyer, doctor, or tax preparer, etc., not deductible. Professional reputation, money you pay to improve your professional reputation, as such as expenses of appearing on television or on radio. Relief fund contributions. Residential local telephone service, even if you use your phone for business. To claim a telephone business expense, you have to have a second phone line installed for business use. This is a really old rule that has pretty much gone obsolete because so many of my clients no longer even have a home phone line. Most of them do all of their business by cell phone, and the interesting thing with cell phone is the IRS does allow a proration on cell phone, even if it's your only line. But if it's a landline, their argument is you'd have the landline anyway, and so we're not going to allow a business expense deduction for the landline unless you have two lines, and then you could argue that the second line is for your business. Haven't really seen anything adjust in that, but I think there should be an adjustment there. Stockholders' meetings are not deductible. Tax-exempt income expenses. You cannot deduct expenses you paid to produce tax-exempt income. Travel as a form of education. Travel expenses for another individual. Voluntary unemployment fund contributions. And finally, wristwatches. Nice try. Even if your job requires you to have a wristwatch, it is not a deductible expense. So are there any questions coming in? Let me see. Nancy Kiefer, are keeping payroll statements or records of self-employment income in a safe deposit box deductible? I would say yes. If you're a business owner and you are looking for a safe place to keep your business documents, so you take out a safe deposit box, I would say that is deductible, and it would even be recommended. IRS certainly on its disaster information does say that you should be taking efforts, not just as any business owner, but also as a tax service owner. Are you prepared for a disaster? Have you done efforts to back up all of your client data and protect your client data in the event that there is a natural disaster, or not even a natural disaster, say a fire, or a theft even of property on your premises? What kind of efforts have you made to secure that property and protect it for future for your clients? You can see that the manual also has some information about the alternative minimum tax in it, and I'll leave that for you to peruse on your own. I've already kind of discussed these items several other times in other courses, but coming up in August I teach a class called Understanding the Alternative Minimum Tax, and we'll really get into it there. The main thing you need to know about alternative minimum tax is its sole function is to take away various deductions you claim on Schedule A, but it does allow the key mother of all deductions. Whether you pay alternative minimum tax or not, you are allowed to claim a full benefit from deducting your mortgage interest, but alternative minimum tax does not allow deductions for the standard deduction, dependents, employee business expenses. So remember we just talked about all of those employee expenses and everything subjected to the 2% limit. If you're paying AMT, you may as well not bother because AMT is going to take them all away again. I actually did a return a few years ago for a client. He has enormous employee business expenses, but he was subjected to AMT. There was no point in even bothering. They didn't help him. They saved him money under the regular tax, but not under AMT. Come to think of it, I think we did claim them because they helped him on the state. Our state of Oregon doesn't have an alternative minimum tax, but on the federal, it made no difference. Stovokor, S-T-O-V-O-K-O-R, Stovokor. Katrina Brewer is single. Her AGI is $47,229 for 2012. Her 1098 mortgage interest is $5,000. Her property taxes were $1,000, and she had $1,829 of state withholding on her W-2. In 2012, Katrina's home belongings and car were destroyed by flooding, and at the time of the flood, she lived in Massachusetts, it says. She had the following casualty loss for 2012. We're providing you the information here. Go ahead and prepare her Schedule A in 4684.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
Coming back from break, I'm going to open up the answer key now. See how you did. I'll also broadcast the results. Most of you are getting the right answer because I boiled it down to multiple choice and kind of process of elimination. Just randomly, you're going to hit the right one because it seems logical and there's no other logical option. But I just want to keep both of these open at the same time. So answer number C is the correct answer, and the majority of you have chosen answer number C. But I've opened up the answer key here just so we can all see why. And I'm going to slide this table up to the very top so that we can see the numbers in the original problem and how they end up applying to the finished Schedule A in 4684 for Katrina. Firstly, we're just going to look at how much her loss is. And to calculate that, clearly we have to do the 4684. So let's bounce over to that. Hopefully that's large enough on your screen that you can see what I'm doing here. Okay, I think I've maximized it while still allowing you to see everything. So we've got Katrina, and we're describing each item of property lost. Clearly, where it says personal belongings up here, we would have to have a very long, lengthy list. But for purposes of teaching the class, that's not practical. So we've just given a lump summation here. And looking at the table up top, we see that there's a basis in the house of $200,000, a fair market value before the event of $235,000, and a fair market value after the event of $0. It's totally lost. Insurance paid $185,000. So I pretty much know that the difference in loss of fair market value is $235,000, but the basis is only $200,000. So we're going to have to go with the basis as the lower number. And from that basis, we'll subtract $185,000. When we do that, if you were just totaling some numbers, you could have put $15,000 off in the margin here. And then we have the personal belongings. They cost $45,000. The fair market value before the event is $29,000. The fair market value after the event is $0, and insurance paid $27,000. So in this case, the fair market value difference is the lesser number. We're going to subtract $27,000 from that lesser number, and if you did your totaling, that would be $2,000 off in the margin. And then for the car, the cost is $26,500. Fair market value before is $15,000. Fair market value after is $0. That means the difference in fair market value is the smaller number. $15,000 minus $11,000 gives us $4,000 to enter in the margin. Well, if we look at the 4684, we've basically got all those numbers lining up exactly as I just described on the form itself. We start off by entering the cost basis of each asset in columns A, B, and C. We then enter the insurance reimbursement in columns A, B, and C. And then we look at the fair market value immediately before the event in columns A, B, and C. We take the lesser of the difference in the fair market value or the cost basis after subtracting out insurance. And on line 9, we enter those three amounts, $15,000, $2,000, and $4,000. When we add all of those up, we get $21,000. Well, $21,000 is the option I gave you of option A. That is the loss, but it's not the deduction that will carry to Schedule A and be entered on line 20. We first have to subtract out the $100 rule. We then have to subtract out 10% of her adjusted gross income. And when we've done both of those steps, we're left with $16,177. And of course, I do have her Schedule A in here for you. On her Schedule A, I threw in a few other numbers for you to have a more complete Schedule A. One of those was income taxes withheld for the state on her W-2. The other was real estate taxes. We also had home mortgage interest. And then finally, we add the casualty loss deduction on line 20. Once we've entered that casualty loss deduction, we add up all of the numbers, all of the expenses she has, and she has $24,006 of itemized deductions that she gets to claim.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Perth. P-E-R-T-H. Perth.